Hey everyone, Joe here from Avalon. Today we're taking 5 minutes to learn about shareholder loans. This is a big topic and often misunderstood, but it's really important for business owners. We'll cover what your shareholder loan is and how to use it. We'll also look at the problems that can arise with the CRA and how to avoid them. If you want a deep dive on the subject, please also check out our full in-depth video on shareholder loans linked in the description below. All right, let's get started. A shareholder loan represents funds you've either contributed to or withdrawn from your corporation. It's a common tool, but it's essential to understand how it works to avoid tax problems. Your shareholder loan account shows the amount of money you've loaned to your company or borrowed from it. If you withdraw cash from your company that isn't allocated as a salary or a dividend, it will likely show up in your shareholder loan account as funds borrowed from your company. On the flip side, if you deposit some of your personal funds into the company account to pay for your business expenses, then you'll likely see in your shareholder loan account as money loaned to the company. You need to keep an eye out on shareholder loan accounts because it's a common place where bookkeepers can make some mistakes. For example, if your bookkeeper mistakenly records an expense payment as a shareholder withdrawal, you could end up having to take that money into your taxable income personally. In this example, your company would also miss out on the tax deduction, so you'd be paying more on the corporate side as well. So understand how your shareholder loan works and review it every month when your bookkeeper sends you your monthly reports. As a side note, if you're not receiving monthly reports from your bookkeeper, make sure to discuss with them to ensure that you start getting regular updates. You should be reviewing your income statement, balance sheet, payables and receivables on a monthly basis at a minimum. And if you don't have a bookkeeper that provides regular monthly reports, check out Avalon Accounting's bookkeeping services linked in the description. We look after your monthly bookkeeping and provide timely, useful financial reports to help you make informed decisions and drive towards your business goals. Moving on to how to use your shareholder loan account. When an owner withdraws money from the corporation without designating it as a dividend or salary, it's recorded as a loan. This is known as a due from shareholder transaction because the shareholder owes this money back to the company. If you accidentally use the company funds for personal purchases like buying a TV for your home, it's considered a loan from the company to you. This needs to be repaid to avoid it being taxed as personal income. If you deposit personal funds into your company, it's recorded as a loan from you to the company. This often happens in early stage businesses that don't have the cash flow to pay for operating costs. This is known as a due to shareholder transaction because the company owes this money back to you. No formal contract is required here, and it's rare that we see shareholders charge their business interest or set out repayment terms. Another way this happens, if you pay your business expenses directly with your personal funds, it's recorded as a loan from you to the company. This ensures that you get reimbursed and the expense is correctly recorded. Your shareholder loan balance is the running total of all shareholder loan transactions. Your accountant will likely refer to this as a debit balance or a credit balance. If you withdraw more than you contribute, the balance you owe the company increases. This is often referred to as a debit balance in your shareholder loan account or due from shareholder. If you contribute more than you withdraw, the company owes you money. This is typically called a credit balance or due to shareholder. While there are no tax issues when loaning money to your company, tax problems can arise when shareholders borrow money from the company over a period of more than 1 year. This is because the CRA may consider the loan as personal income if it remains unpaid. Consequently, you might face double taxation, once on the deemed personal income and again as the company cannot deduct the withdrawal as an expense. If you do find yourself in this situation, there are a couple ways to remedy it. First up, you can repay the loan. Repay the loan within 1 year to avoid it being taxed as personal income. However, you cannot do this every year or you may fall afoul of the series of loans and repayments rules set out by CRA. So if you're planning to take the money out only to repay it and take it out again after year end, you are clever, but the CRA is on to you. You can also take the funds as wages. This means that you take the funds into your personal income and the corporation will get a tax deduction for the wage expense. Remember that payroll deductions will apply here, so be sure to check out our video series on running payroll to understand how these work. Lastly, you can opt to take the funds as a dividend. Dividends are taxed at a lower personal rate than wages, but the trade-off is that the corporation doesn't get to deduct them as expenses. For more details on salary versus dividends, check out our video linked below on how to pay yourself from your corporation. Shareholder loans can be useful for managing cash needs and providing flexibility, but they need to be handled correctly to avoid tax issues. I hope this video has helped clarify shareholder loans for you. If you want any other info on other ways to finance your business besides your own cash, I suggest watching our video on how to finance your business link below. That's all for me for now. Thanks for watching, and we'll see you in the next video. Cheers.